Anat Admati, The Banker's New Clothes, What's Wrong with Banking and What to Do About It, Updated Edition. Discover the truths behind the banking industry's resistance to reform in the aftermath of the 2008 financial crisis. The Banker's New Clothes by Anat Admati exposes the dangerous practices of big banks, such as their reliance on debt for financing and their opposition to stricter regulations. Get ready to debunk popular myths that banks propagate in order to maintain the status quo and uncover how their risky actions endanger the economy. In this summary, you will learn about the unique characteristics of banking as compared to other industries, the origins of banks' dependence on debt, and the solutions that can improve the safety and stability of our financial system.
The banking industry and financial reform. Bankers against serious reform of taxpayer-rescued financial industry. Since the 2008 financial panic, the banking industry has been lobbying against substantial reform of the taxpayer-rescued financial industry. Bankers believe that the crisis was a fluke and attribute it to a one-off occurrence. They reject stricter regulations, claiming it can impede economic growth and increased consumer cost. Bankers warn to reduce lending if Congress imposes longer borrowing rules or enforces more capital to be borrowed. They predict complete economic ruin if regulators implement measures to maintain financial stability. Bank executives think that banking differs from every other industry because it finances over 90% of its assets through debt. Banks avoid the expensive equity market and rely on cheaper debt, which is easier because creditors know that large financial institutions seen as too big to fail will receive government rescue assistance during difficult times. Taxpayers pay the bill with destabilizing bailouts, whereas society does not subsidize polluters to damage the environment. Large banks take risks that everyone pays while they alone profit from it. The banking industry needs political will to reform the current system for the economy to work better. The risk of debt. Debt provides immense leverage, but it also magnifies risk, leaving borrowers vulnerable to increased losses if investments fail. Companies often combine debt and equity to fund growth and are cautious about their investment decisions. However, banks, which deal with money and power, often rely on debt with equity levels as low as 6% to 8%, a practice not applicable to most individuals or corporations. Such overhanging debt in times of crises can make them excessively cautious or reckless, leading to bankruptcy eventually. The intricate world of banking. Banks play a critical role in the economy, executing payments, mediating the flow of funds, assessing risk, and lending money to businesses. However, their core practices pose great risks, particularly the concept of maturity transformation, which involves funding long-term investments like loans with short-term debts like deposits. Bank runs are a common issue, and while deposit insurance helps to mitigate them, bad loan decisions, risky endeavors, and untested financial innovations also lead to problems. The 2007 to 2009 global crisis is a testament to the risks involved, with the failure of large banks creating a ripple effect across the world. Government bailouts propping up weak banks also pose significant challenges, with taxpayer resources drained and economic capacity strained. For the banking system to become safer and sounder, it is crucial for banks to use less debt and more equity. The true cost of weak banks. Banks warn that regulatory reforms would increase their costs, which consumers would have to pay. However, the hidden expense of maintaining weak, indebted banks whose instability threatens all of society costs much more. The dissonance between what bankers say and what their businesses convey is striking. For example, J.P. Morgan Chase CEO Jamie Dimon refers to his firm's fortress balance sheet. But its off-balance sheet commitments total almost $1 trillion. Banks like J.P. Morgan Chase are much bigger than they were pre-2008 crisis, but they are no less fragile. Bank size also raises questions about costs and vulnerability. Institutions with more than $100 billion in assets may be less efficient, less manageable, and less governable than smaller banks. Clearly, large banks cost society more because of the implicit too-big-to-fail government guarantee. The capital reform debate in banking. The debate on banking reform has predominantly focused on restricting what banks can do by constraining the asset side of their balance sheets. However, regulating the liability side in the form of capital reform has received less attention. The Basel Accord was created to set minimum bank equity levels but has since become toothless due to disagreements between banks and regulators on assessing asset risk levels. Banks use equity as a pool of funds they set aside to support their activities. They argue that equity capital is too expensive and debt is preferable. However, equity would be less expensive if the banks were less leveraged. Bank executives receiving compensation based on their bank's profits and stock have every incentive to bet on risky debt-financed deals. Investors in shares of highly leveraged banks require a greater return on those shares because the bank's leverage is inherently riskier. The more equity a bank has, the lower the risk of distress and insolvency, the less vulnerable to runs and the risk of defaulting on debt promises. The cost of government guarantees. Banks benefit from both explicit and implicit government guarantees that lower their borrowing costs. Deposit insurance and the implied promise of a bailout shield creditors, shareholders, and investors from losses. This guarantee is perceived by the market as making too big to fail banks more secure and less risky, resulting in cheaper borrowing costs. In 2008, the U.S. spent $900 billion to save its banks, while other countries paid hundreds of billions as well. However, research shows that these subsidies contribute more to banks' profits than productive growth. The cost of these government guarantees globally was a staggering $2.3 trillion in 2009. Strengthening the banking system. Governments and banking institutions must take drastic measures to strengthen the banking system and prevent future financial meltdowns. This can be achieved by immediately suspending cash dividends and increasing equity levels. Authorities should aim for 20 to 30% equity levels instead of the minimal 3% requirement set by Basel III. Banks must also abandon the illusion of fine-tuning by accurately estimating their equity needs and relying only on equity to absorb losses in a crisis. Regulators should not let banks count hybrid securities as capital and only consider equity as a reliable source in times of crisis. The idea of being too big to fail should not exempt banks from higher equity requirements. Despite resistance from banks and politicians, political will is needed to foster a safe and stable banking system while avoiding the dangers of global competitiveness.
Anat Admati's The Banker's New Clothes reveals that big banks have constantly resisted much-needed reform, claiming it would result in numerous unintended consequences. The book argues that the focus should be on strengthening banks by increasing equity requirements, tapping into equity markets, and abandoning the illusion of fine-tuning risk management. Failing to transform the banking system will only result in the perpetuation of a fragile and risky financial environment. The key to making these changes lies in political will and rejecting an unsustainable status quo influenced by the symbiotic relationship between bankers, politicians, and lobbyists.